Good afternoon. Welcome to the Heritage Foundation and our Lewis Lehrman Auditorium. We, of course, welcome those who join us on our heritage.org website on all of these occasions. Would ask those here in-house if you'll be so kind to check one last time that cell phones have been turned off as a courtesy to our speakers. We will, of course, post the program on the Heritage homepage following today's presentations for everyone's future reference. And our internet viewers are always welcome to send questions or comments simply emailing speaker@heritage.org. Hosting our discussion today is Norbert Michel. Dr. Michel is our research fellow in financial regulations here at Heritage. He studies and writes about housing finance, including the reforms of Fannie Mae and Freddie Mac. He also focuses on the best way to address difficulties at large financial companies in the too big to fail problem area. Before joining Heritage in 2013, Dr. Michel was a tenured professor at Nicholls State University College of Business. He had previously, though, served here at Heritage as a tax policy analyst and with the global energy company Entergy. He holds a doctorate in financial economics from the University of New Orleans and earned his bachelor in business administration and finance and economics from Loyola. Please join me in welcoming Norbert Michel. Norbert?
Thank you. Thank you all for being here today and joining us as we talk about Peter Wallison's new book. And just a quick bio for those of you who don't know Peter. Peter holds the Arthur F. Burns Chair in Financial Policy Studies and is the co-director of AEI, American Enterprise Institute's program on financial policy studies. Obviously researches financial topics, banking, housing, insurance, and securities regulations. From 1981 to January of '85, Peter was general counsel of the U.S. Treasury Department and later served as White House counsel to President Reagan. More recently, Peter was a member of the congressionally authorized Financial Crisis Inquiry Commission from 2009 to 2011, where he had obviously a unique view of the 2008 crisis. He's the author of many books, including Ronald Reagan, The Power of Conviction and the Success of His Presidency. And then one of my favorite book titles also is The Gap. You have to see that one to appreciate it. As well as the new book, Hidden in Plain Sight, What Really Caused the World's Worst Financial Crisis and Why It Could Happen Again. And of course, that's the reason that we're here today, to have Peter present some issues that are in his book. And just to sort of set everything up, I'll talk for just a couple of minutes, and then Peter will give his presentation, and then we'll have some time for Q&A. Basically, if you know me or follow any of the things that I do, I've written about Peter's book in my last Forbes column. That piece sort of frames what the book is about, why it's such a good book, and that's kind of what I'm just going to do right now, just sort of frame what Peter's presentation is about, and then I'll just turn it over to him. If I had to frame the issue in just one sentence, I would say that Peter's book is a must-read for anyone who wants to get the story straight regarding the financial crisis, because it's the best collection that I've seen of documented facts regarding the crisis. Too many policymakers have been getting away with this false narrative that government policies had very little or nothing to do with the financial crisis, particularly with respect to the affordable housing goals. And Peter's book sets the record straight. And he doesn't do it with unsubstantiated opinion, but with on-the-record statements from government officials, HUD officials, and GSE executives. And in many cases, these issues were discussed openly in the public well before the financial crisis was even a thought. On the face of it, it's kind of hard to believe that we're even having this debate at this point. But as anyone in Washington knows, history has a way of sort of getting muddled very quickly. Or we could say people will tend to be creative with their history. I don't know how we want to put that. But the truth is that the financial crisis is one of the clearest examples yet of government policy gone wrong. And this is not to bash any political person or any political party or any particular person, but one of the starting points for this government policy gone wrong is Bill Clinton's, or was, Bill Clinton's national partners in home ownership. This was set up as a private-public partnership that had an arbitrary goal of raising the U.S. home ownership rate from about 64% to 70% by 2000. Now, since roughly 1968, the rate had sort of steadied right around 64%. And now all of a sudden we have the federal government openly saying, no, we need it to be 70%. And they openly partnered in this program with the GSEs with the express goal of financing that expansion. In other words, the express goal was to get more people to borrow more money to buy more homes. So you don't really need a PhD in economics to sort of guess that something might go wrong with that sort of program. It should be obvious, I think, that at least some financial institutions would have to lower their credit standards, for example, in order to get to the 70%. Otherwise, we wouldn't have steadied at 64% for over 20 years. Peter's book actually documents the evidence that backs up this common sense observation. He cites public officials and GSE executives that admit credit standards were lowered. Just one example is Fannie Mae's 10K from 2006. There are others in the book. The book also documents how important the GSE standards were relative to the rest of the market, the private market with non-government-backed loans. On the face of it, this seems strange that we would have to, in any way, prove that this was true, that Fannie and Freddie drove credit standards in the market. Virtually anyone that took out a home loan from the mid-90s on, maybe even a little bit before that, knows that this is the case. If you walked into a bank to get a loan for a home, the starting point was, do you qualify for a GSE loan? But I've attended conferences, many conferences now, where especially audience members do not agree with this fact and will not give you any time at all as that being true. And again, Peter gives documented evidence for this fact. And it's, I think, illustrative that it's one of the pieces of evidence is a HUD Advisory Committee report from 1991. So this is well before we have any sort of major problem in financial institutions. And they admit that national underwriting standards were, for a substantial fraction of the mortgage market, were set by the GSEs. Also, I've attended several conferences where audience members and even panelists insist that the risky mortgages that were in the system, the ones that brought everything down, were driven by private label securitization and had nothing to do with the GSEs. The GSEs were an afterthought. Peter's book does a great job of documenting the relationship between the private label securities and the GSEs. It points out that in 1995, HUD changed their rules so that the GSEs could count purchases of private label mortgage-backed securities to meet their affordable housing goals, provided that those loans contain, or that those securities contain loans to low to moderate income buyers. It's right there in black and white. He cites the 1995 announcement in the Federal Register, as well as a 2005 letter from the GSE's federal regulator to a vice president of Fannie Mae, and also a Washington Post story that picked up on this issue in 2008. There's more, but that's... And then just sort of in general, it gives also an excellent account of how standardized capital requirements contributed to the crisis, because they left many institutions holding essentially the same types of securities, as well as how mark-to-market accounting rules, a terrible idea, forced banks to write down estimated future losses on securities that still have yet to show much of any cash loss. These are all in the book. And I'll just sort of close by saying that I think in general what we have in Peter's book is something that really highlights how important it is that Congress gets these facts right. GSE reform stalled in the last Congress, as any of us following the issue knows, and the left really did get away with a narrative that minimized any role that the government had in causing the crisis and causing the problem in the mortgage market. And almost, although it stalled, almost got away with introducing a new bill that would have basically kept the system intact under a new name. So we need to set the record straight if we're going to fix the problem going forward. And the book makes an excellent case for exactly what was wrong. And now I'll just turn it over to Peter, and that's it for me.
Thanks, Norbert. Well, I do want to thank Norbert Michel before I do anything, because he has not only said some wonderful things about the book in a Forbes article, but also organized this conference, and I'm delighted to be here. And I love the tone with which you were talking about the book, because this is the tone that I sort of internally had as I went through the data. It's unbelievable that we would be in a position now where we have to put into a book and publish 6 years after the financial crisis, almost 7 years after the financial crisis, data that should have been talked about at the time that we had the financial crisis. It's amazing. And yet the American people know nothing about this stuff, because they have been told by the government and by the media that the financial crisis was caused by greed on Wall Street and too much risk-taking on Wall Street. And that was all a basis for adopting the Dodd-Frank Act. That's, in fact, what the whole Financial Crisis Inquiry Commission was about, as far as I can see, and that is to provide a foundation for the Dodd-Frank Act, which, of course, has slowed down the growth of the economy. So I will talk about the book. I'll go through what I think is important, and then hopefully we'll have a chance to take some questions and further elucidate what this is about. But I think you'll find a lot of the stuff in the book, if you read the book, surprising to you. I think Norbert actually found there was a lot of stuff in there that was surprising to him, and he's a scholar in this area. So I do recommend that you try to get hold of it, get hold of a copy, and talk to your friends about it if you like it. That really is important, because the left is giving this no attention at all. There are no, as far as I know, there are no reviews, there are no television programs, there are no opportunities to go on CNN or ABC or CBS or anything like that. To the extent that I am talking to audiences, and I do get some opportunity to do that, it is conservative audiences on conservative programs, which is fine. That's great, and the book is getting some traction. But we're not going to get any help from the people who don't believe that the American people should know about what actually happened in the financial crisis. Okay, so we all know that the 2008 financial crisis was caused by a mortgage meltdown. That is the default of an enormous number of subprime mortgages. What most people don't know, however, is that how many there were, why they were in the financial system, and what turned this large number of low-quality mortgages into a financial crisis. The book I'm presenting today is intended to provide answers to these questions. The conventional narrative about the crisis is that the private sector, Wall Street banks in particular, were not sufficiently regulated. This is a simple and irresistibly attractive story for the media, involving greed by grossly overpaid people, risk-taking with public funds, and bailouts of big banks, while ordinary people were evicted from their homes. And it's become a narrative repeated again and again in the media and by members of the administration. And it's important that this narrative keeps getting repeated, and no alternative narrative gets any attention. A recent Sunday New York Times article by Gretchen Morgenson, for example, said, "It is remarkable," and I'm quoting here, "it is remarkable to watch some financial institutions that wrecked our nation's economy work to heighten risks in the system." She was talking there about this recent Cromnibus law, which reduced to some extent the regulation, tiny bit, the regulation of credit default swaps. It wasn't really a big deal. It wasn't a big deal at all, but it was turned into a big deal by Elizabeth Warren, as we all know, and now Gretchen Morgenson, making a point about that, says that these are acts by financial institutions, she was talking probably about Citibank at this point, that wrecked our nation's economy. And then a few weeks ago, Treasury Secretary Jack Lew wrote in an op-ed, and I'm quoting also, "It is hard to understand the efforts of some to undermine our ability to protect consumers and taxpayers from excessive risks taken by financial institutions." So the narrative keeps getting repeated. The facts, however, are an entirely different story. On June 30, 2008, before the financial crisis, and this is probably the most important single datum in the book, there were 55 million mortgages in the United States. Of these, 56%, that is 31 million mortgages, were subprime because they're, and this is a definitional point, they're subprime because the borrowers had low credit scores. That makes a subprime mortgage. Or they were otherwise risky, technically called Alt-A mortgages, because they had low down payments or some other deficiency in the mortgage itself. Of these 31 million subprime or risky loans, 76% were on the books of government agencies, principally Fannie Mae and Freddie Mac, but also FHA, the Veterans Administration, to some extent the agricultural organizations that also made farm loans. But where's my little device? Well, see, I've checked all this out before and now it's gone. Okay, let's see if this works. Okay, there it is. This is a picture of simplified picture of where all the mortgages were in 2008, just before the financial crisis. Now, if 76% of all these mortgages, all these subprime mortgages and other Alt-A mortgages were on the books of the federal government, that can only mean one thing, and that is that the government and not the private sector had created the demand for these loans. They were the buyers. And here's another fact. After Fannie and Freddie became insolvent in 2008 and was taken over by its regulator as its conservator, it began to disclose its losses and the source of its losses for the first time. Actually, it had not even told people beforehand that it was buying subprime loans, and they've since been sued by the SEC for this. But in August 2009, Fannie reported that 81% of its losses in 2008, the losses that made it insolvent, had come from subprime and other risky loans it held or had guaranteed. Freddie Mac later reported the same. This tells us a lot. If the vast majority of the losses suffered by Fannie and Freddie came from subprime or other risky loans, it was mortgages of this kind that caused the financial crisis. And if 76% of those loans were on the books of government agencies, it follows that the government was responsible for the vast number of and vast majority of these losses. It also follows that the private sector was responsible for the remainder, which is 24%, right? So 76% government, 24% private sector, who then wrecked our economy and who then took excessive risks. Now, this is not a defense of the banks or the private sector generally, although some will persist in seeing it as such, and we're seeing a lot of that in some of the commentary on Amazon.com, which I'll talk about later. Nor is it partisan. HUD, in both the Clinton and the George W. Bush administrations, implemented the same destructive policies. Instead, the book is an effort to set the record straight, to make sure the American people actually know what happened in the financial crisis, not the story the media and the government want them to know, but what the facts tell us. Why is it important? I see several reasons. First, the false narrative was responsible for the enactment, the false narrative being the government's narrative, was responsible for the enactment of the Dodd-Frank Act, easily the most restrictive regulatory law since the New Deal, which in turn has slowed the growth of our economy. Although unemployment has recently fallen, we are still in the midst of the slowest economic recovery since the 1960s. That's because instead of focusing on economic growth after the financial crisis and the recession, we made the financial sector the whipping boy for the crisis. We focused on punishing financial firms for failing without ever investigating why they failed. The book makes clear that none of the reasons advanced in the conventional narrative withstands analysis. For this reason, I've often written and say in the book that the Dodd-Frank Act is illegitimate. It is based on a false narrative and was enacted without any serious investigation of the real causes of the crisis. The illegitimacy of the Dodd-Frank Act is the one thing that has to be demonstrated before there can be any reform of the Dodd-Frank Act. And this is really important from the standpoint of any legislators. They have to show the American people that the Dodd-Frank Act was unnecessary and was illegitimate. It's going to take a long time to do this because the wrong ideas have been fed to the American people, but we'll never get reform, as we could see with what happened with Elizabeth Warren, with the very minor reform that occurred in the Cromnibus. We'll never get reform until people fully understand why we actually had the crisis, and it was caused by the government and not by the private sector. If we have the wrong idea about what caused the crisis, we are likely to make, this is the second reason why it's important, if we have the wrong idea about the crisis, we're likely to make the same mistakes again. This is already happening. This week, the President, through HUD, reduced the premium that FHA can charge for insuring risky mortgages. Reduced it by about 50 basis points, which turns out to be a fair amount of money. FHA now, as most of you probably know, is an agency that insures mortgages for people who cannot meet conventional mortgage underwriting standards. Because these mortgages are risky, FHA must charge more for this insurance in order to cover its inevitable losses. Lowering the premium will both increase FHA's losses over time and the number of subprime or other weak mortgages that the FHA will insure. And that's exactly how the government came to own 76% of all the subprime or otherwise weak mortgages by 2008, and why the taxpayers had to bail out Fannie and Freddie and FHA since 2008. If the American people and their representatives knew that fact, there would have been an outcry when the President proposed to lower the FHA premium. If the President and his political advisors thought there would be an outcry, they might not have done it. It's because the American people don't understand the government policies, the relation between the government policies and the financial crisis, that the same thing is happening again. Third, when the cycle turns and we head into recession, who suffers the most? Clearly, it's the family that will be evicted, and those families turn out, most of the time, to be the people the government helped. In 2010, Barney Frank, now you all know that name, Barney Frank, one of the sponsors of the policies that were so destructive, finally had an epiphany. In 2010, he told a television audience, it was actually on Larry Kudlow's show, it was a great mistake, and I'm quoting here, it was a great mistake to push lower-income people into housing they couldn't afford and couldn't really handle once they had it. Finally, when the government takes losses on defaulted mortgages, the taxpayers aren't the only ones who are hurt. Every mortgage that fails and every eviction that occurs drives down the value of every house in the neighborhood. In other words, all American homeowners suffer when the government increases the likelihood of defaults by lowering underwriting standards and encouraging weak mortgages. Well then, how did government policies cause the crisis? Let's begin at the beginning. Fannie and Freddie, the two government-backed firms that dominate the mortgage markets, do not make loans themselves. They buy loans from banks and other originators and either hold them in portfolio or securitize them and sell them to investors. Before 1992, Fannie and Freddie would buy only prime mortgages. Really important fact. These typically required at least 10% down payment, a low debt-to-income ratio after the mortgage was closed, usually not more than 38%, and a solid credit history. Now we understand a solid credit history to be a FICO score above 660. These are not really tough standards. The median FICO score in the United States is 710. So 660 is not that difficult to reach. But that was one of the constituents of a prime mortgage before 1992. Because of Fannie and Freddie's insistence on prime loans, the market was relatively stable before 1992, with default rates below 1%. Yet, even during the period of prime underwriting standards, and this was before 1992, the home ownership rate was 64%, where it had been for 30 years, as Norbert said before, and where it is again today after all the foreclosures and evictions. So, what this says is that you can have prime underwriting standards, that is, prime-type underwriting standards of the kind I outlined, and still have the kind of solid home ownership rate in the United States, 64%, that we have had historically. That's an important fact because you now hear every day about what's going on in Congress and so forth in the housing industry, that if we ever went to a 10% down payment, people would not be able to buy homes. So we're floating around a 5% down payment for the good mortgages today, and the regulators are trying to push that down to 3%. So I think what we ought to understand are some of the facts about what was actually true in the mortgage market before we had the financial crisis, as well as why we had the financial crisis. In 1992, however, Congress adopted the affordable housing goals in order to increase mortgage credit for low-income borrowers. The goals imposed quotas on Fannie Mae and Freddie Mac when they bought mortgages from banks and other originators. At first, these quotas were modest. They required that when Fannie and Freddie bought mortgages, 30% had to be made to borrowers who were at or below the median income in the places where they lived. Now, this was not a tough standard. If they just opened the doors, about 30% of the mortgages they would receive if they were insisting on prime mortgage standards, about 30% of the mortgages would be prime mortgages. But over the years after 1992, HUD gradually raised the goals so that by the year 2000, 50% of all mortgages Fannie and Freddie bought had to be made to people at or below the median income, and there were also some let me show you on this, there were also some categories too, so you can see on that there are categories also that were put into place over the years that required loans to people who were in very low income condition or were minorities. And they had to balance all of these things when they bought mortgages. They had to find them to meet each of the new categories that are up on that list. And these are these are FHFA figures, the Federal Housing Finance Agency. This is the regulator of Fannie and Freddie, and this is their table. They show, incidentally, when the new standards went into effect, which not the year in which they were actually adopted. So for 2001, for example, they went into effect in 2001, but they were adopted in the year 2000 by Governor Cuomo when he was housing secretary. When more than half of the mortgages they were required to buy had to be made to borrowers below the median income, it was impossible to find prime mortgages. Fannie and Freddie had to reduce their underwriting standards. By 1995, they were accepting loans with 3% down payments, and by 2000, loans with no down payments. HUD also reduced FHA's underwriting standards, putting them in competition with Fannie and Freddie for the same low-income borrowers. That's how, by 2008, 76% of the subprime and other risky loans in the United States ended up on the books of government agencies like Fannie and Freddie, which were the largest, and FHA, which was slightly smaller. But that's not all. The huge influx of new buyers, helped by government-backed leverage, built an enormous housing bubble, the largest in U.S. history. That's a pretty good housing bubble right there. These, incidentally, are Robert Shiller's numbers. He's a professor at Yale. And the bubble that we had between 1997 and 2007 was 9 times larger than any bubble we had had previously, and those two are those little bumps you can see in the post-war period. When housing bubbles grow, defaults decline because the home is worth more, and people who can't meet their mortgage obligations are usually able to refinance. With few defaults, the market looked safe, and many commentators believed that the risks of subprime loans were low. Moreover, Fannie and Freddie did not disclose how many subprime and other risky loans they bought, as I mentioned earlier. They said in SEC filings that their exposure to subprime loans was, quote, minimal, close quote, or, quote, less than 1%, when in fact it was 17%. Their managers have since been sued by the SEC for these false statements, and that case, which was begun in December of 2011, has still not been resolved. But it's an important fact because it shows that when people looked at what Fannie and Freddie were doing, especially at the SEC, they found it deficient in respect of disclosure, certainly. The failure of Fannie and Freddie to disclose how many subprime and other risky loans they had misled everybody. Here we're talking about mortgage analysts, market analysts, regulators, risk managers, and investors. They were all misled about the riskiness of the housing market as 2008 approached. All of this accounts, at least in part, for the growth of private sector investment and subprime mortgages. With 2020 hindsight, after the financial crisis, it's easy to say that the private sector were taking excessive risks. Given the information in the market at the time, however, it's not so clear. In other words, there is a reasonable case that the government's actions, in addition to being bad in themselves, actually lured the private sector into perdition. And there was one other factor at play when the bubble burst. Most of the mortgages held by banks and others were held in the form of mortgage-backed securities. Under accounting rules, and this is something Norbert talked about just a little while ago, these securities had to be marked to market, even if the underlying mortgages were still paying principal and interest when due. When the bubble started to deflate in 2007 and the numbers started to come out, investors fled the market for these securities. And what we see then is a collapse of the mortgage-backed securities market on that chart. Now, if there are no buyers, there's no market, and the value of these securities plummeted, and with it, the capital levels of banks and others as they had to write down their assets. Inevitably, these firms looked unstable and possibly insolvent. The SEC could have suspended mark-to-market accounting, but it did not, despite pleas. The turmoil in the market continued until 6 months after the crisis, when the Financial Accounting Standards Board, which was delegated by the SEC to make these rules, agreed under pressure from the House Financial Services Committee to loosen the mark-to-market rules, finally. At that point, the Dow, it's hard to believe today, the Dow was at 6,600. Almost immediately thereafter, the stock market's recovery began. It's really a remarkable fact if you look at the numbers. When the head of this Financial Accounting Standards Board said to Congress, all right, I get the picture. You're going to change the rules unless I change the rules. Okay, I'll change the rules. After that, the market started to recover, almost the same week and has never stopped. So it's a remarkable thing to see. This changed everything. Managers, well, I missed something here that I want to get back to because I think it's important. Now, why then did what was happening in the private sector here with all of these mortgages failing, why did that turn into a financial crisis? Now, this, I think, is a classic story of moral hazard. Investors, creditors, and managers relying on what they thought was government policy changed what they would normally do under the circumstances of a financial, what looked like a financial decline. In March 2009, the government rescued Bear Stearns, an investment bank that was not government insured. It was just an investment bank. It was not a commercial bank that was offering insured deposits. The Fed provided $29 billion in risk sharing to induce J.P. Morgan Chase to acquire Bear Stearns, which seemed at that point headed for bankruptcy. At that point, too, market participants thought the government had established a policy that it would not allow these large financial institutions to fail. And the market became more or less stable at that point. But it also changed everything in people's heads, at least people in the market. Managers of corporations that might have been in trouble, banks and others, no longer thought they had to raise new equity to reassure their creditors. The creditors would now be protected by the government, at least everyone thought so, at least in the biggest firms. Weak firms, at the same time, thought they could drive harder bargains when approached by stronger firms about an acquisition or a strategic investment. Again, because they figured, why shouldn't I get something from my shareholders here? My stock is in the tank, so I should get a better price for them because the creditors will be protected by the government. So I can drive a harder bargain. That happened too. And then creditors saw no need to recognize losses by selling debt that they were holding in weak firms, believing that they would collect in full if the firm failed and the government stepped in. But in September 2008, the government completely reversed itself and allowed Lehman Brothers to fail. An anxious market immediately became a panicked market. Investors and creditors who thought they had understood the risks they were facing were completely upended. Now they wanted cash immediately. And no financial institution could survive if the rumors spread that it couldn't meet its cash obligations as soon as someone figuratively appeared at the window and asked for his or her money back. So no financial institution was willing to lend to another. Most banks would not lend to any other bank, even overnight. That was completely unprecedented. And that is the thing that really scared a lot of the specialists in this kind of market that just never had seen this. Ironically, the Lehman bankruptcy showed that it had been a huge mistake to rescue Bear. No large financial institution got into trouble or failed because of the failure of Lehman, even though Lehman was 50% larger than Bear. The fear that Bear's interconnections with other firms, and interconnections is the big word here because this is what the Dodd-Frank Act is based on, the idea that when a large financial institution fails, it drags down other large financial institutions because they're all interconnected. Turns out to be false. Because Lehman failed, Lehman was a gigantic financial institution, and no other financial institution failed because Lehman failed. So the whole interconnections idea is wrong. But the moral hazard created by the rescue of Bear far outweighed whatever temporary peace it had bought. As Lehman showed, there was no danger in allowing Bear to fail. And then, if we had allowed Bear to fail, then many other managers would have gone out and sought much more equity to shore up their balance sheets which were looking weak because they had to write down so many assets, they would have raised much more money, much more equity. They would have looked much healthier instead of relying on the government to rescue their creditors. They'd want to keep their creditors with them by collecting as much equity as they could. And then, if Lehman had actually failed, the remaining firms would have been financially stronger and far better capitalized. There would have been no panic, and therefore, there would have been no financial crisis. That's it. That's it. So now I'm happy to answer any questions that you have. And I appreciate your being here. Thank you.
And we'll have somebody come around with a microphone. If you could, please just state your name and affiliation and then ask your question. That would be great.
Do you want to call on? Yeah. Oh, I'll do. Okay. Yes, sir.
Yes. My name is Manny Rosales with the Latino Coalition. And there's a mic. Oh,
There's a mic.
thank you. In your book, do you mention anything about the Community Reinvestment Act? Because I know when I sat on the board of a credit union, and also when I was at a bank, we were really forced into some of those neighborhoods where the actual requirements were lowered. And I think that contributed to the whole effect that it had on Fannie Mae.
It did. I'll say this about it, and that is I don't discuss the Community Reinvestment Act in detail because there's no data about it available. It's one of the strangest things you can imagine, but the government has fuzzed up the data so badly you don't know what banks are actually doing. However, the idea of this Community Reinvestment Act is what underlay the affordable housing goals that were adopted in 1992 and were really influential in causing the crisis. Probably a lot of banks made loans they would not otherwise have made under the CRA, the Community Reinvestment Act, as you were suggesting. But the way they report those things are to report them to the Fed only as high-interest loans, not that they were actually CRA loans, just high-interest loans. Many of them didn't even make high-interest loans because in order to get the mortgages, they had to reduce what they would normally ask in terms of an interest rate so they could find someone who would take the loan. So the whole thing is terribly messed up in CRA, and we can't really tell how much effect it has had. But the idea underlying CRA is alive and well in the affordable housing requirements. Yes?
Jaime Narbonne, Chairman, National Economists Club. Peter, I was wondering if you had any thoughts about whether our monetary authorities, or the Federal Reserve, had any impact in the financial crisis and the current stance today. What are the implications of today's policy for the future in the real estate market and a possible financial bubble?
Yeah, one of the things that I have encountered a lot in talking to economists is the view, widely shared among economists, that the bubble, this huge bubble that we were looking at before, was the result of Fed's monetary policy and not the affordable housing requirements or government housing policies. I have a lot in the book about this because I don't agree with it. And I think economists generally like that idea because there's a lot of data that could be used to support it, and economists are really data hungry. They love to use things that can be demonstrated by data. In the book, there is that chart, but I have vertical lines running from 2000, the year 2000, and the year 2003, cutting through that picture of the bubble. And if you look at those vertical lines, you can see that by the year 2000, before there was any cut in mortgage interest rates, in fact, in 2000, we were trying to restrain the market, and so the all interest rates were much higher. They hadn't been cut substantially. And still, even in 2000, the bubble was already bigger than any bubble we'd had. And by 2003, it was 3 times the size of any bubble we'd had. And it was 2003 where the Fed actually began to cut interest rates in order to stimulate the economy. And that's when John Taylor of Stanford has argued that they departed from good monetary policy. But my view is that it was the housing policy that actually caused the bubble. And it might have been accelerated again after 2003, but it was already a massive bubble because of housing policy before there was any real monetary policy. So I'm waiting to hear back from a lot of economists about what's in the book and to get their arguments on the other side, but I don't see how those arguments really play. Okay, thanks. Good question, though. Yes, sir.
I'm Dino Bruni. I am an economist in the federal government. There is, first of all, the suspicion that a catastrophe of this magnitude has multiple causes, even a perfect storm of coinciding factors and blunders. And there is, on both the left and right, it's probably a minority, which looks to the repeal of the Glass-Steagall Act as somehow being a catalytic factor here. And it seems as though Dodd-Frank was intended to do what the Glass-Steagall Act otherwise would have done without using the Glass-Steagall mechanism. What is your perspective on the Glass-Steagall Act versus Dodd-Frank in terms of preventing what happened?
That's a great question. I love that question because it involves Paul Volcker, who I've had a lot of debates with about this issue. I'm going to have to do this. I'm going to have to talk about the about the Glass-Steagall Act in order to make my point. And I do have a lot of coverage about the Glass-Steagall Act in the book. The Glass-Steagall Act said 2 things. One was banks, insured banks, cannot engage in underwriting or dealing in securities. Just that. The other thing it said was insured banks cannot be affiliated with firms that engage in underwriting or dealing in securities. The 2 things are completely different ideas, but if you can imagine, they don't want the framers of the Glass-Steagall Act did not want the banks to engage in underwriting and dealing in securities, okay? But they also didn't want banks to be affiliated with firms like securities firms that were engaged in underwriting and dealing in securities. What happened in 1999 in the Gramm-Leach-Bliley Act was that the second part, the affiliation provisions, were repealed. The banks were still subject to the Glass-Steagall Act, but they could now be affiliated with others. Now, why does anyone focus on the Glass-Steagall Act? And I think my idea, that the reason they focus on it, is that they had to find some deregulation in order to blame the financial crisis on deregulation. Because there's been no other thing that could even come close to being deregulation in the financial area since the New Deal. There just hasn't been any. But the Gramm-Leach-Bliley Act did eliminate the affiliation provisions of the Glass-Steagall Act. Now, the question is, what effect could that have had on the financial crisis? The banks, the investment banks that are not commercial banks, they are like Lehman Brothers, like Bear Stearns, like Goldman Sachs, those are investment banks. They all got into trouble doing what? They got into trouble buying bad mortgages or buying bad mortgage-backed securities. They were permitted to do that under the Glass-Steagall Act. You could buy and you could sell mortgage-backed securities as well as mortgages, because actually that's what banks are supposed to do. They're supposed to make mortgages or hold securities that are backed by mortgages, because we expect banks to use the monies that they get in deposits to make loans. And that's what mortgages are. So if there had been no, I will make this statement, and that is that if there had been no repeal of any part of Glass-Steagall, if it still remained in effect in 2008, nothing would have been different. There's no way that what happened in 2008 would have affected the events of 2008, which involved entirely simply mortgages and mortgage-backed securities, which was things that banks could always deal in anyway. So, this is what I say in the book. This is the fact. I'd love to have some challenges on that by people who tell me that I'm wrong, but I can't see it. I don't see how it could have been. Other questions?
Time for maybe one more.
One more? Oh, sorry. Oh, wait, let's, you're here, I think, are you not? So let me ask this gentleman.
Maybe two more.
Thank you for your presentation. I'm going to ask a question that maybe not really for, I'm not an economist, but I'm just was stunned by the reading of a book that many people maybe have read here called Sun Tzu, The Art of War, where he highlights many things that can be applied to this crisis. But I will select 2 points. One is he said that a whole country can be robbed from its spirit by psychological trick. And the other one is war can be conducted without visible violence. And if you see what happened in this crisis, even if you are not military, could you imagine that could be a kind of attack through psychological trick?
Yeah, you're talking about the financial crisis being something like Sun Tzu would find as terribly dispiriting to a nation. Yes, I think that happened. I think that people thought that we had lost our bearings completely, that we were going down the river and would never be able to recover our footing anymore. And that's one of the reasons I think that the Congress was so successful in getting the Dodd-Frank Act adopted, because people were frightened, and anything that Congress might do was going to help. There's a terrific book out by James Grant. I know I'm supposed to talk about my book, but Jim Grant's book is a fabulous book about the depression that we had in 1920 and 21.
We'll be here next week.
And we will. You guys are lucky. He's great. But you should buy my book anyway. And his point is the government didn't do anything between 1920 and 1921 for a variety of reasons. Wilson was ill, and the Fed was just getting formed and so forth. And they had a very sharp depression in 1920 and 1921. Did nothing because they couldn't get their act together, and the economy bounced back to be into the roaring 20s, actually. So it's a question really of the spirit of the nation, right? And we are a nation that is willing to go out and work and do things and innovate and create. And, if the government steps in and suppresses everything, as they did with Dodd-Frank, we're not going to have any growth. And that's why we've had 6 years of no growth. So that's a good question, and you're right on target. Our whole spirit was dampened by what the government did in 2010 with Dodd-Frank. Do you want to try one more?
One last question.
Is there anyone else? Diane Katz with Heritage. Why was Bear rescued and Lehman not? I can see if they had not rescued Bear and there were no, repercussions, then they wouldn't have rescued Lehman. But since they rescued Bear, what was the turn? What was the change?
That's a great question. I have a whole chapter on this. because it was, I call it the worst blunder in financial history. And rescue of Bear Stearns was the original sin. Now, it's complicated, so you'd really, and I'm not sure I ever came to a complete conclusion, but it was clear from Hank Paulson's memoirs, his book, that he thought that if Bear Stearns failed, this would have been in March of 2008, Bear Stearns failed, it would bring down all these other financial institutions that were interconnected with it. That's why I mentioned interconnection is so important. Be a big black hole, and they would all just pour into it because they were all interconnected. Now, of course, financial institutions are all interconnected. But the question is, are they so dependent on one another that the failure of one of them would bring down any of them? And I think one of the things that he didn't understand, it's hard to believe this, but I think he didn't understand this, even though he'd been on Wall Street, he didn't understand credit default swaps. And if you don't understand credit default swaps, you can believe that they tie all these institutions together like climbers on a rock wall, and if one of them falls, they all are pulled out and all fall into the valley. That's not what credit defaults are or do or can do. But from the language in his book, it was clear that's what he thought. And so that's why we rescued Bear Stearns. And then he blundered many, many more times in not preparing for the failure of Lehman. And by the time he got to Lehman, he had no way of, he had no resources left, not financial resources, he had no resources of ideas left about what to do with Lehman, and had also been told by many critics that he was Mr. Bailout, and he did not want to remain as Mr. Bailout. And so here's the Secretary of the Treasury. He's got one of the most important jobs in the government, and he's worried about people calling him Mr. Bailout. Now, that's why we didn't rescue Lehman, because, and he said this to Bernanke, and he said this to Geithner, I've been called Mr. Bailout, I'm not going to provide any more money. And so what they did, the moral hazard they created with Bear, became the financial crisis when Lehman was allowed to fail. Thank you.
Thank you very much.
There are books outside. And I'll be happy to sign a book if you buy one, if you care to have it signed. Thank you.